Thank you. I now yield 5 minutes to the gentleman from Massachusetts, Mr. Tierney.
Thank you very much, Mr. Chairman. Thank you, Mr. Browski, for the work that you're doing and for being here today. I just have two lines of questioning that shouldn't take too long. One concerns the Term Asset-Backed Securities Loan Facility, the so-called TALF. This is an idea where they need a AAA rating from two of the rating firms and a not less than AAA rating from the third firm. But we continue to have these rating agencies paid by the issuers, by the people whose product they're rating. You made mention of that in your report. You said essentially they are, and I quote, paid by the issuers of the very securities that they're rating. As a result, the agency has an incentive to issue a high rating to attract future business from that issuer, close quote. And that's one of the problems that got us where we are today in this whole financial crisis. It should boggle our minds that we're continuing down that path and then even relying on those as part of this program. So you would agree, obviously, that we should be concerned about this, but moreover, what do you suggest we should do as a different methodology for the TALF program and others?
Well, this is something we've been pushing through since our first initial report to Congress in February. And we have some suggestions in the report. One of our concerns is a race to the bottom. Moody's has actually came out, one of the three rating agencies, and has said basically that they're losing business because they've been more strict than the other two, and as a result they haven't been getting enough business. Now, we haven't investigated that. We think that the Federal Reserve and Treasury needs to investigate that further. But it sort of raises the ultimate issue of a potential race to the bottom. And then it was expanded. When the TALP went into commercial mortgage-backed securities, they added more rating agencies but kept the number at 2 that are required to get approval. That, to us, only exacerbates the issue of more rating agencies for that race to the bottom to occur. I think what they need to do is what the Federal Reserve, to their credit, has started to do, which is stop relying on rating agencies to do the work, the diligence, the underwriting that stands behind these asset-backed securities. So Federal Reserve has hired a collateral monitor for commercial mortgage-backed securities to come up with its own evaluations as to what these things might be worth in a stressed environment. And we think that it's important to keep pushing in that direction, away from reliance or the importance of rating agencies in this process, to make sure when we're dealing at least with taxpayer money that the level of protection is a little bit higher than what, as you correctly state, got us into this soup in the first place.
What can Congress do to help you push that point? Because obviously if we're not going to have somebody other than the issuer pay, then we should do exactly what the Fed is doing in this program.
I mean, I don't think that, you know, it's not really our policy to advise Congress on specific legislation on these policy issues.
But saying that legislation would be the only thing we could do, or one of the things we could do, whatever, would be helpful generally.
I think it also is sort of worth noting that in the regulatory reform that obviously this Congress is considering, taking a good hard look at what the reforms are for the rating agencies and whether the reforms truly and squarely address these conflicts of interest that had such disastrous consequences leading into the financial crisis.
Thank you. My other line of question has to deal with the credit derivative contracts that AIG held with third-party counterparties. The financial situation when it occurred obviously created a situation where the counterparties claimed that the contract terms had been violated. They demanded either payment or additional collateral from AIG. AIG's lack of liquidity obviously made that difficult to come up with, and there was a contest between AIG and those third-party people as to whether or not there was money owed. If so, how much should it be? And there was a negotiation that was going on that. When Mr. Liddy from AIG was before the committee, we asked him why it was they paid 100% on the claim. And he said that he didn't believe they necessarily should have, that in fact there was a contention amongst that, and he had been somewhat surprised, but he and the people at AIG hadn't done it. That in fact it had been the Fed and the New York branch in particular that had done it. Are you looking at that at all, and are you able to tell us what happened that all of a sudden in contested claims they just up and forked over 100%?
We are looking at that. We have a pending audit into that very specific issue, the credit party payments and the payment of 100 cents on the dollar, and who made that decision. I expect that audit will be finalized by September.
Great. Thank you very much. I yield back.
Would the gentleman yield?
Yes, I will.
Just one quick follow-up. Are you familiar with the XBRL, and are you in a position to help get this kind of transparency database access available to agencies that currently are not reporting in a transparent fashion?
We are familiar with the XBLR product. I heard some testimony about it, and when actually my office received a presentation on it, and it does appear to be a useful type of product to track these types of funds.